leaving some credit on the table. What does that mean?
In California, unlike other states, the environment is very competitive. So you get extra points on the QAP scoring for what they call voluntary basis reduction. So there's a certain amount of credits you can take per the formula prescribed by the IRS. But then if you leave a certain amount on the table, which in California is usually about 20%, that gets you the maximum score, because in California, to be awarded, you need to score perfect, and then you have to win on the tiebreakers. So if you watch the World Cup, it's like winning the penalty kicks.
That was a good one, Hugh.
Uh-huh.
I really like that analogy. The Tucson deal that you guys were able to lock up. How did you know that that piece of land would have qualified for tax credits? Right? How did you assess it for financial feasibility?
It came to me because I volunteer with a group called Making Housing Community Happen. We provide free technical assistance to churches and faith-based organizations that are looking to develop affordable housing, because we found that a lot of developers take advantage of churches where they'll tell them, hey, you're doing something good, just give us your surplus land for $1 and we'll build affordable housing. We just feel it's really a shame that people take advantage of churches. So we see the faith land and our faith partners as community stakeholders, and we see the property as more of community property. So in California, we tend to have a formal process for churches where we have a planner. My counterpart does the financial analysis, and we help the churches to really see if their properties are feasible. We've been getting so much word of mouth from the YIGB folks from the Faith Land Development. And my group received a grant from the Zuckerberg Foundation to help these churches, but it was geographically limited to California. And this church from Arizona reached out to us. A pastor was connected by means of another pastor who was here in Whittier, California. And they were thinking of selling the church. It had gone down to about 20 members. They had extra land that they never developed. So they asked my group, hey, can we do something here? And my group said, our grant doesn't fund us. And they knew that I had already been doing some consulting work in Texas. So they asked if I could look at it, with the only condition that we agreed to pay fair market value for the land and not take advantage of the church. So we did our homework, and it looked to be zoned correctly. It was zoned R2, which allowed for 15 units an acre and had 5 acres. We looked at it, seemed interesting, and we started looking at the submarket, really digging in, looking at the QAP, comparing the previous year's scores, how they scored, or the projects that were awarded and what their score was, and seeing how this would compare against last year's project, and it seemed to be in the money. So we worked with the church, and the church was great, and it seemed competitive.
Okay, welcome to another episode of Affordable Housing and Real Estate Investing. Guys, today I got a real treat for us because I know Hugh Martinez as a guy that is so good with deal structuring, so good with financing. And when I first talked to him and his partner, I said, Hugh, well, I tried to invite both of them, but the guy, his partner was like, you got to bring on Hugh first. So I was like, all right, let's bring on Hugh. Let's really try to get into it and understand from him what he does. So Hugh, welcome to the podcast today, man. How you doing?
Thank you so much. Glad to be here. Doing great.
Man, Hugh, so tell us, for the people that don't know you, right? Who are you and how did you ever even get into the world of affordable housing in the first place?
Yeah, so it was a combination of chance and circumstance. In college, I was a finance and management major, and it just happened that when I was looking at finance gigs, because I always thought I wanted to get into investment banking, all the openings seemed to be for brokerage firms selling their junk mutual funds or their proprietary products and handing over your list of friends and family members, or being an analyst for some of the older long-gone firms like CS First Boston. And I didn't want to be locked up in some East Coast office 80 hours a week, even though there were pathways that were more lucrative or more prestigious. So my senior year in college, I was working for a general contractor, one of the larger landscape contractors. I think they're called Brightides now. So they're one of the, I think, top 10 landscaping contractors. And just happened that I took an independent studying the housing starts in the San Fernando Valley here in Los Angeles. And then when I was taking my time to figure out what I wanted to do, and I really liked the thought of development because of the combination of different tasks that weren't routine, and I liked having the tangible product. But it happened that it's not like there were any formal training programs when I started. It's not like you have bachelor's in real estate development or other combination degrees like construction management with a minor in architecture, what have you. So when I graduated, I worked for about a year. And then, after not really being with a contractor and seeing that it was, strictly construction related and very limited, I had a friend who said that he had a gig with a nonprofit. Didn't really describe it very well. Um, Said that I would be helping so many people that are close to me still can't figure out what it is I do. And it just happened that he told me that I would be helping people and low income families to fill out applications for housing. So, in my mind, it was helping folks fill out Section 8 applications for housing. And I
Mm.
figured, you know what? It's a gig. I can work with this until I figure out what I want to do next. And the nonprofit that I initially worked for, older financial consultant, I don't know, 50 grand or 100 grand. And this was way back in 2001. So when you adjust for inflation, it's substantially more. And they weren't able to put together their financing application for the City of Los Angeles Housing Department. They looked at me and said, "You're the finance major. Can you figure this out?" And yeah, so I got the benefit of learning on the job and making big mistakes without getting fired, which was the best experience. And it was painful, but thankfully the folks at the housing part of the city were committed, and it's like they did help carry that along. And then we applied for this first project was 100 units in North Hollywood. Then we applied to the state of California for financing, and they asked, "Can you do it again?" And it was one of those, okay, let me try. And
And Hugh, let me pause you because I want to make sure
yeah,
I'm catching everybody up,
yeah,
right? So you started off working as a nonprofit and you started working from the ground up. I mean, I think so many people can take so many things away just from your early beginnings because if you are just looking to make an impact, I mean, just getting
mhm,
into the industry,
mhm,
putting your best foot forward can get you so far, get your foot in the
mhm,
door. And now all of a sudden you're learning, right? Like you said,
mhm,
you got to make mistakes on other people's dimes. And that is probably the best way to
mhm,
get your career started and start learning. So I didn't want to miss that point because I think a lot of people think like, oh, I got to go out and become a developer on day one. No, you
mhm,
don't. You don't need to do that. You can figure
mhm,
out what your skill is, figure out a little bit about industry, and then pick where you want to kind of
mhm,
put down your roots in. So you talked, I think you said there was 100 units in North Hollywood that needed funding for a ground up
mhm.
project, or was it a rehab? Tell us a
Correct.
little bit more about that deal.
It was a ground up new construction, and this was interesting because most of the units were 3 and 4 bedroom units. So
Oh,
very large family. It was in North Hollywood. Demographically, at the time, it was predominantly a Latino area, and at the time there was a lot of need for family housing, and particularly because a lot of these were individuals that weren't able to purchase homes, so they needed larger units for their mainly intergenerational families.
and Hugh, help people understand a little bit about the problem that you were facing, right? Were you helping the group get financing because there wasn't a good way to finance these ground up construction projects for 3, 4 bedrooms for larger families? Was there a lack of capital? Was there a lack of land? Tell us a little bit more about the problem that you were trying to solve specifically.
Well, it was more the financing structure because there was a large gap between what we could support with the permanent mortgage. When you get to 3 and 4 bedroom units, what you'll find is that your per square foot rents are significantly lower than your studios or 1 bedrooms, but the costs are still the same. So you're paying the same cost, but percentage wise, your rents are lower. So you need to make up for it with other forms of subsidy. And it was a 4% tax credit deal. So depending on your pricing and where you are, typically it's maybe 20 to 25% of the total capital stack. And because the rents were lower, we had to make up for it with City of Los Angeles Finance. At the time, they put in about 25% of the stack. So we had 25% from the credits, 25% from the city, about 30 from the permanent mortgage, another, I think it was 15 from the state of California, and the rest of it was deferring the developer fee. So the problem was really getting it financed because the project was not competitive as a 9% project. The QAP really favored projects that were in a revitalization area or redevelopment area. And
Mm.
this project didn't score at the time for what the QAP prescribed as on the 9% side.
Got it. Let me say that back to you because I want to make sure I understand exactly
Mm,
everything you said, right? Because I think the audience can understand or can appreciate, wow, you're helping a lot of families, right?
mm,
3, 4 bedroom properties. But the problem was that the cost to build per square foot is
mm,
still relatively high, but you
yeah,
don't get the same proportional increase in the rents on a per square foot basis, even though you have bigger units, but the increase was not proportional. So when the rents are not able to service the debt or the underlying debt
mm,
on the property, that's where
mm.
you had gaps in financing because a lender might not be willing to finance that development because they don't see the rents are able to cover the debt service. So that was the first problem. Did I miss anything
No,
in this?
that's correct. That was the first problem. The second one was that typically with the 9%, well, here in California, it's not other states you could take the complete allocation, but in California to be competitive, you have to leave some credits on the table. Usually the formula here, you have to leave about 20 to 25% of the credits on the table as a 9%. So in California, the 9% doesn't translate directly into the typical 60 to 65% that you'd see in other markets. So in California, even the 9% will maybe fund 50% of the capital stack.
Okay,
So,
2 questions there,
yeah,
Hugh,
yeah.
because I think you're so knowledgeable about this space. And I want to make sure I clarify some terminology for folks because they might be wanting to learn from you, right, Hugh?
Mhm.
What did you mean by leaving some credit on the table? What does that mean?
So in California, unlike other states, the environment is very competitive. So you get extra points on the QAP scoring for what they call voluntary basis reduction. So there's a certain amount of credits you can take per the formula prescribed by the IRS. But then if you leave a certain amount on the table, which in California is usually about 20%, that gets you the maximum score because in California, to be awarded, you need to score perfect, and then you have to win on the tiebreakers. So if you watch the World Cup, it's like winning the penalty kicks.
Oh, I love that analogy. That was a good one, Hugh.
Uh,
I really like that analogy. And you're so good at explaining this. So let me bring it back up a level
mm,
even. So
mm.
is there a simple way of explaining low income housing tax credits for folks? Like if you had a kid or a fifth grader come up to you and ask you, "Hey, what is low income housing tax credits?" I mean, how would you describe that program to them? How would you explain the program?
Well, I would first explain the intent, which is to competitively award funds to procure affordable housing and in the most cost efficient way.
Mhm.
With each state having the ability to determine how to allocate or distribute those funds either geographically or to the portion of the population that needs it the most, so long as it complies with fair housing and FHA. But in practice, what happens is that between the annual recertification of the QAP, sometimes the legislatures will have different policies. They may give you more points for a certain amount of homeless folks, or they may say, oh, we want you to focus on seniors or families. And you'll see these fleeting trends because there was a time when a lot of the local funding focused on TOD developments. And you'll see sometimes there's different policies. I mean, in Arizona, up until this year, you got extra points for what they called phasing. So if you were within a quarter mile of another phase, you scored points as a 9%. So now in Texas, you have the 3 year 1 mile rule where you can't have a LIHTC development within a mile of another LIHTC development within 3 years unless you get a dispensation from the city or the jurisdiction. So the policies are very different, and they're intended to, each body is intended to have the jurisdiction to be able to best utilize those funds. But as the economic conditions change and the priorities of both the electeds, the legislators, and bureaucrats. So you have a variety of different interests and perspectives and how those funds are allocated. So the rules change. It's like playing a board game and having the rules change every time you restart and having to predict what'll happen, with the only benefit being that they have to publish the rules every year before they adopt them.
Ooh, okay. This might be a great question for you then, Hugh, because
Mhm.
I would really love to hear from you. I mean, knowing what you know now, obviously you're very experienced and you've probably read so many QAPs, to qualified allocation plans. So for folks
Mhm.
that don't know, right, every state has their own sort of set of priorities for how
Mhm.
they want to allocate these tax credits that ultimately can be sold for
Mhm.
money to turn into equity to build your project today. Those credits are limited and they have to be awarded to the folks that meets the agenda or the policy, whatever that may be of
Mhm.
the state. So, if you were to start all over again today, Hugh, where how would you go about learning this? Would you recommend folks to read the QAP first? Would you recommend folks to go look for a piece of land first? What do you think is sort of the best approach, knowing what you know now, on how to relearn all the stuff of tax credit?
Well, assuming they could look for a piece of land, or even, that doesn't mean they have to go out and buy it, but at least something that they may think has some value or some prospect of being developed, and really work backwards. Because, and I'll say, start with the tax credit application, because you'll see it's easier to really understand some of what's written in the QAP when you go through the application. And sometimes you'll see some conflicts between the application and the QAP. Depending on what that conflict is, it may work for or against you, or if you have a good jurisdiction that is more collaborative, they may give you an opportunity to explain. Usually, the more competitive states like Texas or California tend to be less lenient when you make certain mistakes. But by filling out the application, it helps you to really understand some of the framework, and really try to understand what a reviewer would see, because sometimes the applications, depending on which state you're in, may leave out some information that should be addressed in the narrative or what have you. So try to see if you could understand the project from a reviewer's perspective.
Interesting. So,
Mm.
do you have an example of what a conflict might be? Like if you saw a conflict on the application versus in the QB, do you have an example of a conflict that you can share with us?
Yeah, so if you look at, so the one that comes to mind is last year in the Arizona QAP for 2024, there was a scoring credit a criteria for site amenities, and the QAP said you could choose A, B, C, D, E, F, G, and get 5 points for each of these categories. When you went to the application, it said you could only pick three of these, and this is its own separate category. So you have to be cognizant of that, especially if you're a newcomer. It seems that, it's like boxing. The champion doesn't it just has to make it to a 12th round to keep his title. But if you're a newcomer, you have to win and really prove that you understand what you're doing.
Whoa. I love your analogy. Dude, you're so good with analogies, man. I love this one. That was a great example of a conflict between QAP versus the application, because then it almost felt like you wanted to maximize your points, but you almost couldn't in that application because you only had to pick three of those amenities. Am I understanding that? How did you work around that?
Well, there was a certain bucket where you had a choice, and then another one that was mandatory. But the way the QAP was written, it made it seem as though you could pick any one of those regardless of bucket.
Okay.
Mm.
Hugh, what I'm taking away from this is that you're clearly an expert in this situation. And I want to just briefly highlight how can people work with you? Because if they want to rely on you for your
Mhm.
experience with LIHTC and financing and deal
Mhm.
structuring, when should people reach out to you? Is it, hey, they got a piece of land that they can have site control over, or maybe they're just in preliminary negotiations with the seller, or maybe they own the property right away? When is the right time to engage with you so that they don't have to relearn 20
Mhm.
plus years of experience with LITAC?
Mhm.
and instead just rely on your experience? Like, when is the right time? Because I really want people listening right now to say, hey, that's me. I got that piece of land. I should be reaching out to Hugh.
Mhm.
Help make that real for me and the audience.
Well, I think first they have to also understand that they have to be able to tie up the land long enough for the award. And depending on where you're located and market conditions, I mean, if you're in, say, in Bethlehem, Pennsylvania versus West Hollywood, you're not going to get an escrow longer than 90 days without paying a premium. But say you're in Bethlehem and you're doing a brownfields of a farm, next to a steel mill that may have some contamination issues that you could remediate, you may have the 2 year escrow, 3 year escrow, and be able to figure it out. So I would say the first thing is site control, but also be mindful that depending on where you are, funds may be limited and agencies have a set of protocols. So there's some predictability, but that also means that the process doesn't move very quickly. So I would say if there's a potential to tie up something, because people don't just want to start making offers or putting options on anything, because what you'll see is that every state has its own sweet spot and certain criteria that makes a deal more competitive or more ideal for affordable housing, especially if you're financing with credits as opposed to financing conventionally or unconventionally.
That's a great point, because I would hate for people to lock up a piece of land. They
Mm,
don't have a way to finance the
mm,
construction of the property, because then now
mm.
you're creating a bad experience for the seller, because you might
Yeah.
have locked up the deal and say, oh, this is going to take 6 months, when
Mm,
maybe in California or LA you could take up to 8 years to get a project
mm.
entitled.
Yeah.
It could take a really long time, and
Mm,
a seller might not be willing to give up site control for that long. They might just
mm.
try to say, hey, I'd rather just sell now, because they
Yeah.
might have different motivations, right? So you
Mm.
talked a little bit about the sweet spots. Could we go over maybe some sweet spots that you mentioned, if at a very high level? Like, let's cover the 3 states you talked about. What would be a sweet spot for a California deal? How long would that be? Or how long would that take?
Well, in California, because a lot of the credit applications require at least two layers of financing, usually the city and the county, usually the city and state or city and county before you get to the credits, you're looking at maybe a year and a half, two of financing, 2 years of construction, and maybe a year of pre-development. So if you're lucky, you'll get 5 years. Arizona moves fairly quickly because the entitlements aren't really as onerous. And it's possible to, I mean, the Desert Dove project we have in Tucson, we locked up the land in October of 2022 and we applied to the city December of 22. So 2 months in, we applied, we got the award in January for the city subsidy, and then we applied for the credits in April. So in less than, when in about 9 months, we had a 9% deal awarded. The downside is that Arizona doesn't have as much credits as California or Texas. So this year we're expecting to see eight awards or so. And you also have to be strategic because Arizona, the first three slots go to the rural deals. Then you have one that's a choice neighborhoods and innovative or unique opportunities. So the first five spots are already taken. So that means everyone is fighting for the last three remaining spots.
Wow. And how about Texas?
It's somewhere in between where it takes a little longer than California. I mean, a little longer than Arizona, but less than California. So about, I'd say 3 to 4 years. The one thing that I will say is that on the tax and bond financing, Texas is a little different because the Attorney General reviews every housing bond that gets issued, whereas in other states that doesn't happen. So that's a potential landmine for somebody coming from out of state where the IRS gives you 180 days to close from your allocation. So the state review already eats 30 to 60 days of those 180 days. So you have to keep that in mind in terms of meeting the closing requirements to preserve your allocation.
Ooh, thank you so much for going through. I mean, those are details that a lot of people frankly don't know, and it just speaks to the level of competency you have in this space. So I want to dive a little bit deeper. Maybe let's talk about the Tucson deal that you guys were
Mm,
able to lock up, right? Because you
mm,
guys have made tremendous amount of progress in there. It's a
yeah.
great deal that you guys are working on right now. How did you know that piece of land would have qualified for tax credits, right? Did you read the QAP in advance? Did someone already bring you a piece of land and say, "Hey, Hugh, figure it out. What can we do with it here?" What kind of happened there? How did the events transpire on that project, and how did you assess it for financial feasibility?
Well, it came to me because I volunteer with a group called Making Housing Community Happen. So we provide free technical assistance to churches and faith based organizations that are looking to develop affordable housing because we found that a lot of developers take advantage of churches where they'll tell them, hey, you're doing something good. Just give us your surplus land for $1 and we'll build affordable housing. In one case, a developer even received a $20,000 donation from the church congregation and took the land for $1. And we just feel it's really a shame that people take advantage of churches because you have to remember that regardless of whether you practice something or you don't, the people that founded this community chipped in to put it together. So we see the faith land and our faith partners as community stakeholders, and we see the property as more of community property. So in California, we tend to have a formal process for churches where we have a planner. My counterpart does the financial analysis, and we help the churches to really see if their properties are feasible. And what happened here was we've been getting so much word of mouth from the Yigby folks from the Faith Land Development. And my group received a grant from the Zuckerberg Foundation, from Chan Zuckerberg, Mark Zuckerberg's wife, to help these churches, but it was geographically limited to California. And this church from Arizona reached out to us. The pastor was connected by means of another pastor who was here in Whittier, California, and they were thinking of selling the church. It had gone down to about 20 members, and they had extra land that they never developed. So they asked my group, hey, can we do something here? And my group said, our grant doesn't fund us. And they knew that I had already been doing some consulting work in Texas. So they asked if I could look at it with really the only condition that we agreed to pay fair market value for the land and not take advantage of the church. So we did our homework, and it looked to be zoned correctly. It was zoned R2, which allowed for 15 units an acre and had 5 acres. So we looked at it, seemed interesting, and we started looking at the submarket, really digging in and looking at the QAP, comparing the previous year's scores, how they scored, or the projects that were awarded and what their score was, and seeing how this would compare against last year's project. And it seemed to be in the money. So we worked with the church, and the church was great.
I want to make sure that I'm following. So you guys had a deal right from your volunteering, and the church knew of your group's reputation. So they
Mm-hmm.
said, "Hey, if anybody can figure it out, it would be Hugh and his partners."
Yeah.
And you did some evaluation. You already looked at the QAP from last year, so you exactly knew what type of projects would score the highest or score the most points.
Mm-hmm.
So that's how you figure out it would work. And at that point in time, right, were you engaged as like the co-developers, like a joint venture partner? How does that structure work? Because that's usually one of the biggest questions from
Mm-hmm.
folks. They're like, how do we structure it? Is like such a big question.
Uh-huh. So, and I do want to rewind a little bit. So in California, my group, we have a strict anti-conflict policy. So usually if I provide technical advice in California, there's a limit as to my interaction because they don't want me to do one of these deals, right? So this is the best deal. So I could steer it to my skill set, because what you'll find is that different developers have different skill sets. And I saw this in Sacramento. There was a church in a part of town that's very valuable, and they hired a consultant who charged them $200,000 to do a feasibility study. And that consultant made a recommendation for market rate housing, and he said the best developer was one of his affiliates. And he also made the church sign this non-disclosure where if they said anything to anyone, they'd be liable to cough up the 200 grand. And they ended up selling their lot for half of the appraised fair market value and half of what they should have gotten for it. So anyway, we do have in California, we do have an anti-conflict policy in states where where we're not active. We just agree to the fair market value based on the MAI appraisal. So there's no so that we treat the churches fairly. But going to the different structures, so it really depends on really the church. I know that there's a lot of technical assistance from, say, LISC or Enterprise that encourage the churches to develop. Usually the biggest challenge is a lot of states have experience requirements, so you have a certain minimum level of experience with tax credit deals to be competitive. Sometimes it's just even flat minimums. And the other challenge is always the financing, the guarantees. And even though financial institutions really enjoy assisting nonprofits and faith groups, from an underwriter's perspective, you're not going to foreclose on a church, so you need somebody that is able to sign on the dotted line, that is willing to remunerate the financial institution if the deal goes sideways. So those are the two biggest hurdles I see. But I have seen churches do JVs. They form CDCs if they plan on doing community development, especially the larger churches that may have a deep bench of parishioners or congregation members. And it really depends on their bench and who they have. I wouldn't necessarily recommend it if they don't have a solid team. Generally, we do both. Usually, we recommend ground leases, unsubordinated, because what's happened is that there are some folks that will say that they're ground leasing it, but they'll subordinate the ground lease to a construction loan or some other debt, and the church doesn't understand that they could be foreclosed on.
In that situation, it's because even though the church is leasing the land to the
Uh,
developer, the lender has a first lien on the property. So they could foreclose, and the church can never recuperate any of their dues from rent from the ground lease. Is that what you mean by
Correct.
subordinated? Okay.
Yes. And some developers will say, offer pastors, hey, here's 200 grand, 300 grand, and we're going to build affordable housing. The pastor may not be somebody that's a business person, maybe a school teacher or a musician or, just a lay person. And they don't understand the implications of subordinating the ground lease to the construction loan. They may just think it's part of the process. So when we also, just as a public service announcement, recommend unsubordinated ground leases for churches so that at least they keep their land, and hopefully if they'll have some sort of reversionary rights at the end. Because our thought is, if we work with the church and they help us, there's the charity part and there's the pecuniary compensation. So it's like, if the church helps you get across the finish line, I think that it's not going to kill you to, at some point, give them the apartments back and let them re-syndicate it, renovate it, or benefit from that transaction.
So, I mean, it sounds like there are, based on what you said, there are a couple of flavors
Uh,
of how to joint venture with you, right? One was you
yeah,
talked about where the church is gonna, let's say, lease a big part of land that they own. Maybe it's a
yeah,
big parking lot that they don't use,
yeah,
and develop can build apartments on it, but they would lease or rent the land from
mhm,
the churches so the church can make some revenue off of the
yeah,
land, right? The other ways might be where the church is contributing to land, but maybe not as a
mm,
ground lease. Maybe they actually participate in a joint venture.
uh,
Maybe they share in the
mm,
developer fee. Maybe
mm,
they share in the cash flow from the rents. Maybe they share in the net proceeds from any capital event, right?
mm,
Those are all options for you guys to discuss how that joint venture or how that partnership might make sense, because depending on how deep the church's bench is, right, in terms of their expertise, their resources, or maybe they're relying more heavily on you, right, Hugh, for
mm,
your
yeah,
expertise at LIHTC. So
mm,
that these large projects are meant to be flexible. And that's why I always tell people when they say, hey, how do I structure this? You got to understand what's problem you're solving for the church first. Because if you understand what they need
mm,
and you understand what they already have, then you can figure out how to fill in the gaps and bring the value to the table and really
mm,
help them build affordable housing, which is the ultimate end result
mm.
of all of this negotiation. So did I miss anything? Are there any different structures that you might have done or creatively structure with faith-based and churches?
No, it's pretty much what you've noted. The JVs with some participation, ground leases, also sales. Some churches just prefer flat out sales,
Mm,
and that's more because they feel that there's some sort of insurance risk or what have you. Frankly, I don't see it, but I'm not their carrier, so I can't speak for the perceived risk.
That's an honest developer, guys, right there. Because some developers say, "Oh yeah, let me just take it," right?
Yeah.
And Hugh, you're definitely not that type of person based on just how you've been answering the question today. So I really commend you on that, Hugh. I think it takes a lot for people to be kind-hearted, people to be open and transparent in how you approach these conversations to truly make it a win-win-win for everybody. So, Hugh, I want to talk a little bit more about. We talked a little bit about structuring the deals, right? So, if you're a church and you have land, reach out to Hugh and his team to figure out how you guys can potentially partner on something like that to create more affordable housing, because these types of creative deal structuring is what you need. But when it comes to financing, we talked a lot about LIHTC, low income housing tax credits. I think you and I have talked about like drawdown bonds and other kinds of financing. Could you explain some other sorts of financing mechanisms that are available to affordable housing developers today, Hugh? Maybe we can cover the drawdown bonds that you were talking about briefly on our phone call the other day. And what are they? Let's start with that.
Yeah, so typically with bonds, they come in either the public offering or private placement. With the public offering, you have to go through the SEC regulations and ratings. So generally, you bid out the bonds and you get more competitive pricing, your interest rates are lower, but the administrative costs are higher up front because there's more regulations that you need to comply with. So it generally tends to make sense on larger deals. On smaller deals, or also if you need the speed, private placements make more sense because you're not marketing the bonds. You already have a captive buyer who's going to buy it, but you're not going to get the best. You're not going to get the best interest rate, but you're going to make up for it in speed and surety of closing. And with that, if you go to some of the regional banks and even some of the national banks, instead of issuing the bonds and then putting the proceeds in a GIC and taking interest and getting negative arbitrage, there are the private placements. You could structure it as effectively as you would a construction loan, where you just get charged interest on each draw, and that the bank usually just handles the internal mechanics of how they source their funds. So it's not really, it's streamlined. Although I will say, the flip side though is that on the bonds where you do draw them, where you do fully draw them at close, you also have more construction interest during the construction period, so there's more bases. So, on one hand, you save interest costs on the drawdown bonds, but you also have less tax credits because you have less construction interest bases. It seems that it's very project specific. The fully issued bonds tend to seem to make more sense on larger projects.
And I want to explain, right? I mean, I've seen projects where people have approached us and said, "Hey, can we do 501c3 tax exempt bond offering for this ground up project?" And usually those projects don't work because you have to essentially pay interest reserves and pay interest on the entire stack. And for
Yeah.
a $100 million project, $50 million project, that doesn't make the deal pencil because you essentially have to borrow so much more money up front just to get the project started. That's why I wanted to ask you about drawdown bonds, because it dramatically decreases the amount of interest expense, like you said, if you only pay interest as you draw down. So
Yeah.
do you typically see drawdown bonds? Do they max out at a certain limit, Hugh? What size do you typically see folks issuing these drawdown bonds for in terms of like dollar value?
Well, the issuers, or I should say the purchaser of the bonds, usually will go through the standard underwriting guidelines where they'll go up to 80% loan to cost. The issue is not so much with the financial institutions as it is with the state agencies, especially if you're in a state where you're oversubscribed for tax bonds. So generally, you just have to meet the minimum, the 50% test, where 50% of the aggregate basis is financed with the tax and construction bonds. And generally, it makes sense to shoot for about, at least California and Texas markets are competitive, about 55% of the aggregate basis, and finance the rest either through the taxable bonds, recycled bonds, or through some other bridge products.
And this is a great example of if you're pairing with like low income housing tax credits, right? This is the point where you have to decide if you're a developer to say, hey, what am I going to draw down first? Because if I draw on equity first, right, I don't have to pay interest on it. But you also never want to run into the risk of not meeting the 50% test, right?
Yeah.
Because then it can cause the whole deal to fall apart and people can lose their tax credits. And that's a big no-no there. So Do you typically see tech drawdown bonds only for LIHTC deals, or do you see them paired with just like regular market rate deals?
I've seen them more, I would say that it seems to be almost exclusively with light tech deals.
And you mentioned that some of the issues are national institutions or states. How does someone even get that process started, right? Because there are tons of developers out there right now that might be market rate, and they're trying to get into the space. And they're just trying to figure out, how do I even get this started? Is it like, do you apply for these bonds through the state? Do you apply for these bonds through a local financial institution? Tell us a little bit about the process and what that might entail to get access to this financing.
Well, the first thing would be to talk to somebody who has authority to issue the tax and bonds. So there are different agencies, and different states work and have their own unique process as long as they comply with the IRS. So, I mean, here in California, you apply to the California Debt Limit Allocation Committee. But the first step is to find a author, somebody who can issue bonds for the jurisdiction, whether it's a city, a housing authority, or some joint powers agency. Other states, the state gives pots of money to allocate to certain geographic deputies, so to speak. So generally, I would say it's to find out who has the authority to issue the bonds, and they could help direct you in terms of putting a team together, in terms of your counsel, maybe a financial consultant that they've worked with, if this is something that's new to you, and generally guide you with the timelines and sort of the deliverables that are required to start looking into issuing a bond. And some agencies are very easy to work with. They know that you're scratching the surface, so you just need a basic pro forma, your application fee, 2 grand, 3 grand, whatever it is, just to show that you at least have some skin in the game, and they'll start working with you to help guide you through the process.
And should people start working? So for these situations, right? Should people start working on the LIHTC application in concurrency with applying for state financing? What sort of sequencing should they follow first? Right? Get the land, do the application, apply for state financing. Is that the right sequence? What would you recommend?
Yeah, I would say keep the bonds and the credits concurrent. And some states have more defined procedures that help you from letting processes blow up in your face. So in California, the requirement is that you submit the tax credit and the bond application within 30 days of each other. In Texas, they don't have that guidance. And I've seen this happen from word of mouth, that a developer who wasn't familiar with the process applied for the credits and then missed their timeline for the bond, so they couldn't
Oh
close it.
no.
Yeah.
No. Oh, that's so. This is why you can listen to a podcast with Hugh to prevent that problem.
So, needless to say, some agencies tend to provide more developer protections, because what you'll see is, and you also see it in the policy. So, I mean, California, a lot of the funding agencies will give you more points if you're a charter or if you have a nonprofit. And even the tax exemption requires a nonprofit. I mean, you go to Texas, the housing authority usually or some agency gets your tax exemption on your behalf for a fee. So you'll see the differences. So if you look at Texas, it tends to be more for-profit dominated. You look at California, it's very non-profit dominated. And same thing, New Mexico, they try to protect their locals. You need to partner with a local nonprofit to get a local choto to get their home funds, which are a scoring criteria. And I completely agree with it. It's a smaller state. Their nonprofits do good work. So I understand the logic and I agree with it. But these are things you have to understand and have to know in different areas you work with, because some people may have different thoughts and their business model may not make sense for them. And the reason I say that is, if you have a large shop, you need big deals to really feed your back office staff. If you're a smaller shop, you don't need as significant deals to take care of your people.
Yeah, that's exactly right. And Hugh, I mean, this has been such a great conversation, and I really want to, man, I'm just so grateful you came on today, and I want people to appreciate like just how much experience you have with you, and that you were able to kind of digest, like just disseminate that information in such a digestible manner today. I mean, how many units have you built in your career, and like how much funding have you been able to obtain, like in totality for all these projects? Do you have a number? Have you tracked that?
No, because I've also done some consulting projects, and then there are projects where I co-developed, or I should say, where I was a project manager,
Hmm.
and I was only there for a chunk of time, but where I would say it's less than half of the project life cycle. So it's like, well, I mean, do I really count this or not? So, uh,
Yeah, you should count those. Come on, Hugh. I mean, playing a part is
mm,
what a team is all about. I
mm,
mean, everyone that helps deliver a championship,
mm,
in this case, housing,
mm,
I think that should count. So, I
mm,
mean, you just have like 1,500 units. That's a significant
mm.
achievement, Hugh, just to be a part of and to get funding for all those. I mean, I'm sure those projects are we up to like $1 billion, Hugh? What do we think in terms of like value for all those units?
Somewhere around there. Yeah,
You're being
these
so modest.
California price.
Oh man. Well, Hugh, I knew it was probably close to there, if not clearly exceeding 1 billion. So, Hugh, this is the question I ask everybody, right? And the reason I ask is everyone has told me that you can't solve for affordable housing. You can never solve this problem. And I always say I disagree because I think it's just a matter of time before we collect all the pieces to the puzzle. And I truly view you as one of the key pieces to that puzzle because of how much information you were willing to come on and share with the public. And I know by you pulling back the curtains today on what LIHTC is and how to structure some of these deals, there's going to be churches, there are going to be faith-based organizations going to reach out to partner with you. But the question is, Hugh, why do you think affordable housing, particularly the lack of supply of affordable housing, it's just like has been so hard to solve for?
Well, I think it's that there hasn't really been a coherent policy, whether there's a shift from the focus on for sale and home ownership to affordable rentals. And if you look at a for sale product, the benefit that you get is conceivably that those homeowners will pay into the tax base. Whereas with affordable housing, I've had elected officials flat out say that they're not going to see any tax revenue because of the properties generally are property tax exempt, and you don't have the homeowners. But at the same time, it's like, well, how much money are you spending down to buy down the mortgage on a for sale product versus an affordable product? And here in California, where we have a homeless issue in the major cities, the question is, well, to do a homeless unit, I need this much subsidy because I'm at 30% AMI, and the folks there can't really cover much of the rent. So the only way to make them work is with vouchers. And even if you want to serve, there's sort of generally the funding sources give you points for deep targeting. So sometimes you have 30% units without vouchers. So it's like, well, I need a deeper subsidy. You may be giving up 360% units for 130% bedroom. So it's like, well, what's the best way to relieve some of the stress? Because clearly we have a need to help the individuals that are unhoused, but we also can't ignore the families or the service staff that need housing. So there's a very difficult balancing act, and this really hasn't been a comprehensive policy that everyone agrees with, because you'll see the changes, and the elected officials change every 4 years, and the bureaucrats are there forever, and they do provide some valuable insight, but they sometimes carry over some of they may be holdouts and not effectuate the new policy. So I think there are some structural issues in that prevent the collaborations from pivoting as quickly to the needs and the changes of the community.
Well, Hugh, this has been such an eye-opening conversation, man. I have learned so much from you today. I am just so impressed with how you're structuring these deals and how you're approaching helping all these folks. Man, for I can't wait to have you back on the podcast, man, because this is going to be good. Because I want to bring you back on and talk about a deal that even deeper than what we did today. Because I know we talked a lot about high level concepts, but I want to go deeper. And for people that want to reach out to you or they have a project or they have a piece of land, how can they get in touch with you, Hugh?
Yeah, so my email is Hugh, Hugh, at GHK, Gary Henry Kitchen, Arizona spelled out.com. And if you could just let me know that you got my contact through this podcast, I'll connect with you and help you look at the viability of the project.
And Hugh, right? We talked about Arizona, Texas, California today. I mean, is there a state that you can't help people in? Tell us a little bit more about the scope of where you can operate.
Well, generally, we operate in the Southwest, so California, Nevada, New Mexico, Arizona, Texas. We do have contacts in other regions. So if it's outside those regions, we have a good amount of contacts to cover a good amount of states outside those regions. Florida is one that we want to get into. We think it's a 5 year plan for us just because logistically, getting to Florida from Phoenix or California is a long flight. You just can't fly in and out in a day. So we're looking to make some changes to be and add to our team to cover that. But I would say that's within our 5 year plan.
Man, I can't wait to see how much growth you guys have because I think you guys have the right heart, you guys have the right intentions, and more importantly, you guys have the right competency and skills to help really deliver such a big impact for so many families. So, man, Hugh, I'm so grateful for you, man. Without people like you, I would have never had the home I grew up in. So I appreciate your dedication to the space. I appreciate your willingness to share all this information because I wish I had someone like you when I was going down this path of affordable housing. And sometimes it was just really hard to find people. And I'm so grateful that you and your partner answered your messages and were so willing to come on. So I appreciate you so, so much, Hugh. Thank you.
You're welcome. And like I said, I had the benefit of learning on the job without getting fired.
For-
So, there are so many good people in the nonprofit world.
All right. This is such a great conversation. Hugh, I'm going to put your email down in the show notes below. Guys, if you guys want to reach out to Hugh, please look at the show notes. Leave a comment if this was helpful. And Hugh, I'll see you soon. All right.
All right. Thanks so much.